Well, good morning and welcome back to the Broadcast Retirement Network's Sunday podcast. I'm Jeff Snyder, your host for the next 60 minutes as we go around the globe with members of the media, financial services, and academia to analyze the news in retirement markets, technology, personal finance, and so much more. We've got another great show for you this week, so sit back, relax, and listen to this episode of BRN Sunday. Well, let's kick things off with a look at the latest social media trends. And joining us on the line, Devin Banerjee. He is a senior financial services editor for LinkedIn. Good morning, good afternoon. Hello, Devin.
How are you, Jeff?
I'm doing fine. I wanted to cover all my bases. I guess the only thing I didn't say is good night. But Devin, great to talk to you as usual. You take time out of your day for the network, and we certainly appreciate that. You have a lot going on, managing a team and also managing the financial aspect of the platform, meaning the financial services aspect of the platform. So, we see you both, or hear you on the podcast, but also see you on the network every week. So we appreciate that. So what's top of mind this week for you and the team at LinkedIn?
Yeah, absolutely. So tomorrow in the U.S., Jeff, is Veterans Day. Every year we try to look into our data and do some original reporting around the state of veterans returning to the workforce here in the U.S. So, the long and short of it is, of course, veterans often face a really challenging civilian job market when they leave the military and return. On the surface, things look fine in the numbers. Actually, only 3.2% of veterans are termed unemployed today, according to the U.S. Department of Labor. That's one of the lowest levels in actually the past 5 decades, and it's an even better showing than the overall unemployment rate of 3.4% currently. But the exact nature of those jobs is kind of another story. So my colleague George Anders really dug into this with a great article a few days ago, and this analysis finds that when veterans look for their first jobs outside of the military, they're really 70% more likely than civilians to take a step back in seniority. So yes, they're getting jobs, but they're kind of regressing in their so-called careers. Veterans with college educations are at least 30% more likely than similar non-veterans to be underemployed. So even though these are educated veterans and obviously they're so experienced in leadership from their time in service, they're typically getting low-paying, lower-status jobs that actually don't require their full educations and experience. So a lot of this is, for example, IT jobs. George found that. He interviewed several veterans who have found careers in IT project management, et cetera, which can be good jobs, but are basically, in some cases, paying less than jobs these Americans used to have, and it kind of sets them back on the career ladder. So not a great situation. This has been the case for such a long time, maybe the entire history of military service here in the U.S. The good news is there are so many more recruiters dedicated to veteran hiring, so many more big companies that have put in place programs, whether they're kind of target numbers or quota seeming programs, which I think is great news. So there's a lot more focus on it. There's also a lot more work going into helping classify the skills that veterans have. So we saw a lot of recruiters and other people in hiring positions come out in the conversation that ensued on LinkedIn saying, I've never really known how to quantify and classify the skills that veterans are showing me on their resumes, their leadership skills in service, the projects they led in the military. And so people are putting more work into classifying and quantifying that as well. So I think things are heading in the right direction, but that's kind of the state of the workforce for veterans in the U.S. right now.
Yeah, that's kind of, I don't know. It just makes me sad that these people are protecting the country, in a lot of cases doing really technically important jobs, whether they're running a tank or doing intelligence, gathering or things like that. They're very highly skilled in terms of technology. They're not just shooting rifles, and that they
Yeah.
can't, and that they're underemployed. And it seems to me, Devin, that, and be interesting to hear yours and George's perspective on this, that it almost needs to be like a liaison who takes the classification in the military, whatever that is, the grade that that person is,
Right.
and what their job is, and then kind of translate that into, like, it just seems like, when you go to school, right? You go to college or you go into a trade school, they have like placement services. And the placement
Yep.
services assess your skill set and say you have a degree in X, Y, and Z, or you have this vocation and you would be good here. It seems like that's needed, and a translation service is needed in a way to translate those skills into what is going on today. It seems like that part's missing.
That's absolutely right. And there are some organizations that are working on that. They're a bit small and not able to handle the volume of veterans coming back and looking for work. But there are some nonprofits doing that. As I said, some recruiters are spending some more time even before veterans apply in kind of a pre-screening process, helping them edit their resumes and do that classification. George interviewed a vet who said he spent a lot of time on LinkedIn actually looking at how other people present themselves and their skills, and then kind of used all of those hundreds of millions of effectively resumes that we had as templates for himself, which was pretty cool to see. So yeah, I mean, there are some organizations working on it, but definitely a lot more progress to be made, as you said.
Yeah, and just on a personal note, I mean, I never have understood that issue, and also the VA, like why veterans can't get the health care that they need. I mean, after all, you're putting your life on the line if you are. It's something that really, in my opinion, it's along with police and firefighters. You're putting your life on the line. We got to do something for you. So hopefully this can get worked out. Sorry. Thanks for allowing me a little bit of a soapbox. So what else is going
absolutely.
on? What else?
It's such an important topic. I'm glad we spent time on that. So a couple other topics, some softer ones, but ones that really sparked interesting conversation. Another one was a recent study from the Journal of Applied Psychology about traits in really effective leaders. And the Journal of Applied Psychology really elevated likability, the trait of being likable, as a key driver in successful leaders. So, traditionally, or some people today might think of leaders more as those who are able to give directives, or those who just have a lot of experience, or those who can kind of command and, like I said, give directions, or just, lead big teams. But what's really being elevated in this wider conversation about leadership is the importance of people actually liking you and enjoying you and respecting you as a leader. And effectively what it's getting at is that leaders can have great plans, can know what to do, can have great experience, but if you're not able to inspire the rest of your workforce, especially in big organizations, if you're not able to have them be self-motivated by being inspired to follow you, then none of those well-laid plans or those thought-out initiatives and strategic directions are going to be pursued. So it sounds obvious when you say it out loud, but I think a lot of leaders, as they're rising the corporate ladder or looking for those jobs, are not really putting in the work themselves to be likable, is effectively what this research found. So really interesting for anyone who sees himself or herself as a leader, or sees themselves in the future as wanting to become a leader. Likability is just so important.
Do you see that as an acknowledgement that the way we looked at leadership in the past has morphed, especially with the generation we always talk about, how people now value the ESG, the sustainability, being on a mission, and now that has really morphed how we perceive leadership?
I think so. I think it ties into a lot of those topics which we've talked about in the past. I think leaders need to be, and you'll hear all the big CEOs of companies these days talk about this, I think leaders need to be more transparent and more open themselves about kind of themselves as humans and what their values are and what's important to them, and not just kind of be behind the glass of the C-suite or the corner office on the 45th floor of the building. And so I think it's all related. I think younger people today, as you alluded to, for them to be inspired to follow the direction of a leader, I think they want to like that leader and respect that leader. So absolutely, I think this has morphed a lot over time.
Yeah, interesting.
Yeah, and then just quickly, a third topic that actually sparked a really interesting conversation. We called it "Why We're Awful at Meeting Deadlines," and this is quite personal to me. I always feel like I'm missing deadlines, and actually, a peek behind the curtain for the listeners. Every week when Jeff and I record this, I'm often texting you, Jeff, right before we're scheduled to talk and asking for a couple more minutes. So I really need to work on this. But what these researchers found is it's not always just laziness. It's not just procrastination. I mean, people who really are productive and dedicated to their work are still missing deadlines. And they raised this notion of the planning fallacy. And in short, I'll be short here. It basically means that a lot of us are really bad at adding up the time it takes to complete a lot of individual tasks, or we try to do that and we underestimate how long things take. So the practical takeaway here is that when you're planning your day or your week, just adding in buffer times around that project you think you're going to do on Thursday morning and you're going to get out the door by Thursday midday. Instead, give yourself till 2 o'clock in the afternoon or 3 o'clock in the afternoon and just build buffer zones around your schedule. So very practical advice I'll leave everyone with, because I've started taking it into account, and it's definitely helping me so far.
Well, you know what, Devin, you are likable and you're smart, and because you're likable and smart, you're a good leader, and I will follow you anywhere, literally, almost anywhere. I mean, I'm not going to follow you on your next trips to London and India, even though I would love to visit, but I think we just speaking for the audience and our show, you can have all the time you need to prep because you are a great asset to have on the show, and you bring a wealth of knowledge, and we certainly appreciate that. And so, no harm, no foul in our book, and whatnot. So, Devin, certainly appreciate you making time, and we'll talk to you tomorrow on the network as well. So, take care of yourself, and have a good rest, and we will talk to you soon.
Sounds good. Take care, Jeff.
Bye.
Yeah.
Bye.
Welcome back, everyone. Now it's time for our tech segment. Joining me on the line, Senior Technology and Consumer Products Reporter from The Motley Fool, Dan Klein. Hey, Dan, how are you?
My voice is being held together by tea and honey at the moment.
I'm so sorry. You were traveling, and I think it's tough for that recirculated air, but we certainly hope you feel better and appreciate you coming on the program. So let's get right into it. A lot going on in the tech world, but I know one story you're covering is a new budget plan for T-Mobile.
Yeah, so T-Mobile is waiting on that. They finally have FCC approval to merge with Sprint, but there's still a lawsuit out there from I think it's 13 different state attorney generals. And I am very much in favor of the T-Mobile Sprint merger because for all the talk that if the merger is allowed, prices will go up and everything will become non-competitive, I think that's silly because T-Mobile's entire business model is doing things that are consumer-friendly that anger AT&T and Verizon. And what T-Mobile has come out and announced is a few things, assuming the merger goes fully through. The biggest one for consumers is that they're going to offer a $15 a month prepaid plan. Mm-hmm. What that means is there's two ways to get a phone. Prepaid is you pay the bill for the month in advance. Postpaid is when you get billed. In this case, you'll be able to get a prepaid phone, you either buy a phone or bring a phone, for $15 a month. And that will give you 2 gigs of high-speed data up to 5G where they have it. And then after that, it'll be slowed down to 2G. So for people who don't use their phone for a ton of video, that is a tremendous offer. It's half the price of what anyone else is offering. And it's sort of a stick it to the government move by T-Mobile to show, hey, look, if this merger goes through, we're going to keep lowering prices and doing consumer-friendly things.
Yeah, and where does T-Mobile, I would think that T-Mobile and Sprint together makes a pretty good size company compared to their rivals, the top providers, you correct me if I'm wrong, Verizon, AT&T. So how would they compare?
Yeah,
Those two big behemoths.
So right now, T-Mobile is the number 3 provider.
Okay.
And if you add T-Mobile to Sprint, T-Mobile will be the number 3 provider. It will just be a much stronger number 3 provider that will have a chance of overtaking AT&T and Verizon. The point of this merger is infrastructure. So if you have to build out a 5G network and continually invest in technology and hardware, it is better to do that spread out over 110 million customers than spread out over 65 million customers. I'm guessing at the numbers a little bit. But that allows you to do things like innovate, like add new technologies, like lower prices. Because the more customers you have, the more revenue that's coming in, but you don't necessarily need one-for-one infrastructure for every customer you have. So being bigger is definitely better in this space.
Yeah, well, I think it just comes down to, Dan, economies of scale. I think that's the magic word. It's the magic word in record keeping. It's the magic word in a lot of businesses. And I was going to ask you what the coverage was like, T-Mobile versus Verizon and AT&T. Both of the top two, they boast that they have the greatest networks ever created, right? So how would this look in terms of coverage?
I'll speak technically and anecdotally. There are 2 major industry surveys, and they're conducted using different methodology. One of those surveys often puts or always puts Verizon on top, but has shown improvements from generally everybody except Sprint. The other one has consistently put T-Mobile at the top. I think coverage in general depends on where you live. I am a T-Mobile customer. I generally never have a problem, but if I'm at my family home in New Hampshire, there is absolutely no coverage in that town. When I had Sprint, I could I could stand on the high ground and get kind of a signal.
Yeah, that's I mean, coverage is important. I think it can't just be price. But you're right. There are a lot of people out there, Dan, who do not use their cell phone, their phone religiously. They don't demand 5G service. They just want it to check their email like I do, or they want to browse the web occasionally to look things up, or maybe use the Google Maps to drive from, say, Baltimore to Boston.
Yeah, and for that person, switching to a $15 a month plan, where occasionally at the end of the month you have to deal with slow data because you've used 2 gigs, that to me seems like a really, really good deal.
Yeah, absolutely. I know, Dan, you're battling a cold. Just a couple more minutes. I know we want to shift gears and you've talked about Sears in the past, which I think was in some real trouble financially. It looks like they may have secured a $250 million lifeline.
So Sears is the slowest death you've ever seen. It's a theatrical, hammy, over-the-top, played-out death scene. So the answer for Sears has been closing stores. Started with a few thousand stores, now they're down to about 400 stores. They're closing another 100 or so of those, and they've secured a new $250 million lifeline. Most of that lifeline, of course, comes from companies controlled by Eddie Lampert, the guy who ruined Sears and basically stripped it for parts and took all the value out. So this is a story designed to make you say, hey, I can shop at Sears at Christmas if there still happens to be a Sears in my neighborhood, which weirdly enough, we still have one. The reality is Sears is already dead. And the joke I've made about it is Eddie Lampert is going to be in the last Sears store, closing it down aisle by aisle, talking about how bright the company's prospects are. And then on the last day, he's going to be like at the checkout where there's just the impulse items, giving a rousing speech as the company just fully goes out of business. This is one of those cases where you should not believe the headlines. This is not a safe place to shop for something you might have to return. If you can go to a Sears and get a great deal on something you need, that's fabulous. Don't buy a sweater.
Yeah, hey, Dan, let me ask you a question here because we talked about Jeffrey the Giraffe and Toys R Us, and they kind of reconstituted themselves, I think, as a window for Target, a virtual window for Target, right? Is there an opportunity here for the same circumstances, or is it because it's retail, it's just there's no shot?
Yeah, I mean, look, I think once Sears closes for good, we're going to get a million Sears' backstories. Mm-hmm. The reality is Toys R Us opened a few boutiques and a website that's serviced by Target, and it's a niche brand. It's like Sharper Image went away, and now there's Sharper Image products in Starbucks and Target. That doesn't mean Sharper Image is back. It used to be a chain that was in every mall. So does the Sears name mean something? Yeah, it might. There might still be Sears brands or other things out there. But as a meaningful department store chain, Sears is done.
Yeah, I tend to agree with you. I think there's going to be more and more consolidation. It's unfortunate, but that's just the way of business, right? I mean, historically, companies come and go, right?
Here's the thing. This is a case of bad management. Sears saw the internet and didn't adjust to it. It's not the retail apocalypse, it's bad management.
Yeah. Well, Dan, choking up. Don't choke up on us. We certainly appreciate you joining us in the program. I know you're battling a cold, and appreciate you showing up on the network earlier this week or later this week. Thanks so much, and take care of yourself. Drink some more honey and tea. Get some good rest. Kick back the heels. You have my permission to do so. Talk to you soon.
Thanks for having me.
Take care. Bye, buddy. Welcome back, and now time to talk a little markets, and who better to do that? Oliver Rennick, lead anchor for TD Ameritrade Network. Hi, Oliver. How are you?
What's going on, Jeff?
Hey, busy week this week?
Yeah, man. It's pretty wild stuff in markets, stocks, all-time highs, big safety trade unwind. So some of the stuff that we've talked about here kind of coming to fruition. Basically, I mean, the kind of narrative just about the geopolitical issues continues to improve and really just kind of get less dire in terms of how the market is assessing the risk of a even bigger China-U.S. conflict that moving towards a possible phase one deal. I know it's just like this ridiculous back and forth and yo-yo of headlines and nobody really knows what's going on between the two, but it generally seems that they are resolving some issues fairly amicably right now. So the discussion of rolling back tariffs this week had some pretty big ripple effects in markets.
Yeah.
But really what we've been concentrating a lot on is this big rollover that's happened in bonds and in gold, some of the safety trades from the beginning of the year. It's just the market now needs to try and reprice itself on the idea that Armageddon is, in fact, not around the corner.
Yeah, I think it's interesting. We have talked on this show and in other venues about how we've tried to talk ourselves into a recession, and I'm just amazed at the resiliency at how the issues are presented, like these geopolitical issues, and it just, for whatever reason, the market just responds with kind of blasting through. Just looking in today's Friday afternoon at 12:30 your time or 12:15 your time in Chicago and 1:15 my time in New York, and the market's up over 27,000. 27,645 as I'm talking to you.
Yeah.
And it just blows my mind. I remember when we were back at 26,000, people were like, the doomsday scenario. Right. So it just boggles the mind.
Yeah. Well, it's pretty interesting because you've got a stock market that is gearing itself towards a very optimistic, outcome for some of these big issues. And the problem is that while there is definitely a positive force in tariff resolution, for sure. I mean, it's not hard to figure out that the constant, saber rattling of the world's two biggest economic powers is not a good thing for business. So if we move out of that situation, then that's a good thing for markets. It's a good thing for companies. But what we don't know is just how much of the tariff war has really hit activity. And what we've seen now in the month of November, and really since October, mid-October basically, we had a slew of bad economic data here on the manufacturing side in the first week of October, and that's what really started getting people worried that we were going to go the way of the rest of the world.
Yep.
But since then, things have improved. Now, the economic stabilization has been forming without any concrete trade progress, right? All we've got now are talks about trade progress. So if the manufacturing slowdown is ending and the manufacturing slowdown is bottoming out without trade progress, well then to me that logic points to there being other forces at play besides the trade war. Because if the trade war is not resolved, but the manufacturing numbers are showing bottoming out, then there's a good argument to be made that the period of weakness we experienced the last roughly 16 months is more tied to sort of natural cyclical forces, at the 10 years into a long recovery, kind of similar to 2015, where we had a deep slowdown. There were big concerns about how bad it was going to get, and then we kept on grinding, and we kept on moving higher as central banks it supported the market. That's basically what happened again this year. So then the question is, okay, so that's good that the economy hasn't worsened, definitely. But now the stock market continues to run higher, meaning it's getting more expensive without any uptick in earnings expectations. So guidance is not improving. The companies have not given us better expectations for 2020. So really all that's happening is the stock market's just getting more expensive. And that could resolve itself in one of two ways. Stock market comes down to get in line with its actual earnings expectations, or we get a real uptick in earnings guidance and the market becomes, more appealing, no matter how high it is. But we haven't gotten the latter so far. So in my mind, and the way we've covered this, is that there still is building risk here because there are a lot of big moves happening in stocks based on this kind of assumption that things are going to go as good as we hope.
Yeah, well, that's you can have an economy that runs overheated too, and I think the pendulum can swing back. Let me ask you a question, Oliver. Brexit was a huge topic, and I've kind of seen that, and I'm not as in tune with the financial press as you would be because you're covering it all day long. But where's Brexit in the pecking order of all this? We talked about it for months and months and months and years and years, and
Great question.
It kind of went on the back burner. And where is it?
Great question. The first week of October, Brexit provided a really nice tailwind at a time when we were dealing with those economic numbers that were weak, as I mentioned. So Brexit was a good piece of progress as we moved away from hard Brexit. But that basically kind of came to a standstill. And around October 20th, I guess, was when Parliament and Boris Johnson basically said, he had to cave and ask for an extension to the deadline, which is what they got. So the pound has started to give up some of those gains. But I think that essentially the market has moved on from the concept of a hard, destructive Brexit and is now just kind of waiting for the details of what a non-hard Brexit is going to look like. That also being said is, even putting all the details aside, the strength and just the speed of the move in the British pound suggests that there is a similar type of thing going on that we see with bonds and gold too, which was that the expectations for things to get really dire and really, really bad, both in the global economy, the domestic economy, and the Brexit situation, were just overdone. And that's what we had talked about many times before, that my view has been that, positive surprises actually do have some negative repercussions depending on what asset classes you're in. And we saw that this week as bonds and gold got slammed. And now there's an issue of trying to figure out, where they go and how quickly the U.S. Treasury market can sell off without causing bigger reverberations around the financial markets.
Yeah, absolutely. Let me ask you, another question. You brought up bonds.
Big week for bonds.
Yeah, big week for bonds. But we had talked in the past about the yield curve, and that was, it's when the short-term rates outpaced the long-term rates, if I'm not mistaken. Has that kind of recalibrated? That's kind of gone away, and where are we with bonds this week and in the past couple weeks?
The 10-year yield is now at 1.92%. Okay, which sounds low, but relative to where we have been, a low in September of 1.46%, it's been a pretty dramatic move. And this week we saw the biggest Treasury sell-off since the election of Donald Trump in 2016. So we had one of the biggest one-day moves in the Treasury market in 3 years. The reason why this is happening is because there is a recalibration of those economic expectations again that now have to reflect more positivity than anybody really thought was going to happen. The Fed has stopped cutting rates, but there was still a bond rally last week after the Fed told us this. So you've got a market that seems to be very reluctant to part ways with the idea that the central bank is just going to constantly cut rates. So what happened is we had a suspicious kind of bond rally around the Powell event in the Fed meeting, even though they said, look, we're basically taking away the punch bowl for now. We're not going to cut rates anymore. We're also not going to hike anymore. And at the time, that was kind of a weird event that bonds rallied on that. And so this week they kind of woke up as our data remained very resilient. The U.S. economic data is resilient. The rest of the world is not good in its economic data, but it is beating some expectations, and it's not worsening. So now the Treasury market is looking like it was a giant false signal for recession by that yield curve inversion. The yield curve now is back upward sloping, and it is at the highest level, judging by the 10-year minus the 90-day rate, that it's been all year. So this is also something we discussed, that because there was so much speculative activity in U.S. Treasuries on expectations for central bank action, that volatility in the bond market became fairly unprecedented. So with bigger swings means that we should be taking some of the recessionary signals with a grain of salt. And it looks like that was the right way to interpret it for now, because the bond market is moving very, very quickly. And while right now investors were able to stomach this volatility because bond yields were just so low, my inclination and just kind of seeing where people, not even really an inclination I should say, but really positioning of investment managers, positioning in ETF flows, and positioning in the stock market in bond-like instruments, stocks that trade like bonds, is so elevated that it's hard to imagine how further selling of the 10-year at the pace we've seen this week is not going to cause major disruptions. So that's really at the top of my list of things to be looking at, because if the 10-year really starts to take off and there's some kind of trade deal, there's going to be a lot of people that are caught wrong-footed on this trade.
Yeah, let me ask you about exchange traded funds, because you brought it up. I mean, there has been a shift, and we've been noticing this, especially in the retirement world, but a shift to passive investing, and exchange traded funds are well over $4 trillion in terms of the market, the size of the assets under management. How can that dampen the economic results, or because it is managing to an index of most of the time? I mean, there are some hedging ETFs, but what's the impact there in terms of the market? Because we are seeing more people become more passive in the way they're investing, at least the average consumer.
Yeah, well, this has been the trend for 10 years in a very robust way. What's interesting is this year now you're starting to see a tiny bit of breakage with some of that, just because there's been more volatility in the market. So we've seen companies like BlackRock, their stock peaked out in 2018 because they've struggled a little bit to keep up the same growth rate for passive flows. So we actually are seeing a decent amount of active manager performance this year relative to their benchmarks, given the types of volatility that we've had. Because even though we're at all-time highs, it's important to remember the stock market, since its peak in January 2018, is roughly like 6% higher. So there was a long chop sideways that created opportunity for these active managers to show some degree of scale again. So that's kind of helped slow the roll a little bit for ETFs. But in terms of the economic impact or anything on a broad scale, it's hard to really say. I mean, I think that you've also seen a pretty sizable uptick over the last 2 years in retail trading and stuff like that, but that peaked out in 2018 as well. So most of the flows right now seem to be still concentrated in a lot of these kind of safety assets. And the last couple of weeks we saw some pretty big flows into things like utility funds as well still. So it does seem like people are refusing to kind of let go of the assumption that rates keep going lower.
Yeah. Oliver, one more question. I know it's really hard to let you go because you're like a fountain of information. You just keep on. It's like you're like the old faithful, but you're not old, but you're like the old faithful of economic. But a question about sustainable investing. How much has that come up on the network when you're interviewing folks, and sustainability, ESG? Is that a trend that you're covering, that you're seeing on the network?
We talked about a lot of that as this was starting to become more prevalent within the financial community. There's definitely still a lot of firms that focus on finding companies with those characteristics. And there's certain investors who want these particular types of characteristics in companies. There's funds that only target companies with certain ESG scores. There is a decent amount of literature on why companies with these characteristics outperform. But my view has been basically twofold. One is that the outperformance of those companies might be more of a correlation to their ESG principles by being large and established companies as opposed to the ESG principles themselves. So I think that there's been a little bit of maybe I think there could be more rigorous research done on whether or not this really has an impact on a company's performance. And two, I think that when the market was just going up and up and up for 9 years basically, up until 2018 when we started seeing some pretty serious volatility come back. I think that 2017 and 2016, basically from the period of spring 2016 to January 2018, the market just went up non-stop. And in that period, there was a lot of froth that built up in a lot of different places. Froth built up in average retail trading. Froth built up in valuations. Froth built up in things like crypto markets and new digital assets and pot stocks and all these things. And my view has kind of been that some of the ETF explosion also got pretty frothy, both in terms of trying to pin things like ESG characteristics on company success. I think there's a pretty decent argument to be made that a lot of that is a sales tactic, and also a lot of funds that on the ETF side that purport to target certain things, but in reality just kind of mimic benchmarks. So I have a lot of doubts about that as an investment, thesis. But at the end of the day, there's plenty of companies that exhibit these characteristics on a measurable basis where if somebody wants to prioritize those, they can, and they're not going to really miss out on much. And who knows, maybe they will gain a little bit if those studies and literature are correct. But I think it's more just kind of a personal preference on how you feel about owning something like a gun stock or something like that.
Yeah, it's certainly something that people are talking about. I mean, I'm definitely noticing that in what I'm reading online, and it's definitely a conversation piece that many are having, whether or not it's ethical. And there's a report out, I think, this week about how CalPERS and CalPERS in Oregon.
Yeah, they don't want to invest in stuff. Yeah,
and they did better because of it or because of divestment. So I think that to your point, I think you can use statistics in a lot of ways, and I think that's also an opportunity for people to do that with respect to research. Well, Oliver, I'm looking at a list of fountains, and I cannot even see like Old Faithful in the list of fountains. And most of these fountains, it's like the top 10. It's like the top 10 of fountains, and none of them I recognize at all. But anyway, you are a fountain of knowledge. We certainly appreciate you coming on the network. You are a very busy man managing two shows at the beginning and end of the day. People should check out Oliver Rennick on the TD Ameritrade Network. Oliver, always a pleasure talking with you. Have a great weekend.
Thanks, Jeff. Have a good weekend, man.
Bye.
Yeah. Okay, see you.
Welcome back, and we're going to end things as we always do with a chat with the legal eagles, because we need to know what's going on Capitol Hill and the Supreme Court and the regulators. And joining me on the line, one half of the legal eagles, Kevin Walsh. He's a principal with the Groom Law Group, an employee benefits law firm based in Washington, D.C. Hi, Kevin. How are you?
Hey, Jeff. I'm doing well, and thanks for having me on. And you're a veteran of the retirement industry, but on this Veterans Day weekend, I want to say thanks before we get going to all the men and women who serve and who listen to our program and have kind of defended this country. So with that, let's get going.
Yeah, absolutely. I was going to say absolutely, and we second that on this show. And like all of us in the retirement industry, we want to do what we can to support these people so that they have a secure retirement and a secure life post military. So Kevin, that being said,
with the number of times you've said secure, I feel like you're hoping that the Secure Act is top of my mind. Unfortunately, it's not. That being said, there has been some movement on it. There was an effort to bring it to the floor again this week. There's another letter by business leaders sent to the Senate asking them to get going on it. So there's a little more optimism than there was a week or two ago, but I'm still hovering around that between that 45 and 55% chance. It's that sitting on a fence that no one likes. But yeah, so secure is not the topic for this week. This week we're talking about ERISA at the Supreme Court.
Yeah, so let's talk about ERISA on the Supreme Court. Lots going on there, and I think we talked earlier this year about that the Supreme Court rarely takes these types of cases.
Yeah, they rarely take these types of cases, and this year they took 3. So we can count our blessings that the Supreme Court, the highest profile, the arbiter of what applies nationwide, has decided to answer a handful of questions about ERISA. This week they heard oral arguments, which is kind of the last step before they kind of close their doors and start writing their decision, in oral arguments for IBM versus Jander. And the question there is whether, a fiduciary committee can be held liable under ERISA for not promptly disclosing problems that they might be aware of that are non-public when the company holds employer stock. And this is a pretty big case because when you think about who sits on the fiduciary committee for a company, typically you have kind of corporate executives sitting on the committee. And for many plans, one of the investment options is employer stock. And the reason that plans include employer stock is because when ERISA was passed, one of the things they encouraged plans to include employer stock by including an ESOP provision. So essentially employee stock ownership plans. So there's an obvious tension between the idea that you've got this committee of folks who are sitting there and they're supposed to prudently evaluate all the options, and they're supposed to kind of take steps to seek to ensure that the options are all sound investments, with the idea that they might also then, for one of these options, the employer stock, they might have insider information or they might know what's going on before the market can digest it. And this has caused a whole bunch of litigation. And we thought this was settled a few years ago. There was a case, Dudenhofer, and there the Supreme Court said, if you're going to sue your plan's fiduciaries and say they should have done something, the something that you say they should have done has to be legal under securities laws. So you can't say, you had the CFO on your fiduciary committee. He knew the stock was going to tank. He should have acted on that insider information and traded before the market. But what's going on in IBM versus Jander is it's essentially a follow-up where they're alleging that disclosure, that immediate disclosure is a better option than other choices because harm grows over time. Mm-hmm. And it's going to be interesting to see what the Supreme Court does with that. There's some real tension here. If insiders are required to take steps, then it's really tough to have a CFO or a COO on a board because if they take steps through the plan, it's going to tip the hand to the market. You could see kind of some real problems from a corporate law standpoint, securities law standpoint, or even just managing the company. On the other hand, if the Supreme Court rules in favor of the committee, then, what kind of monitoring responsibility is there really for employer stock in plans? Like what role do the fiduciaries serve? So the Supreme Court's got to grapple with those questions, and we expect a decision by June.
Yeah, Kevin, do you I believe that oral arguments in front of the Supreme Court are, at least there are transcripts done. I know they don't do video, but is that available? Like, do we know how the arguments went? Do we know the line of questioning that the Supreme Court made, the justices made
so the transcripts are available. Yeah. And they actually even release an audio file of it. So you can get a feel for kind of what the room felt like. Mm-hmm. I'm real skeptical to make guesses based on oral argument because justices frequently ask kind of devil's advocate questions where they're just trying to probe the kind of the advocates. Mm-hmm. And then you also have Justice Thomas who goes years without asking questions. But it sounds like kind of from what I've seen and heard that the court was very engaged. I think this is kind of a thorny issue because everyone wants to protect participants, but everyone wants to also recognize there are limits under securities law and also recognize that, if we want to encourage companies to offer their own stock, we can't kind of set it up so that it's designed to fail anytime the stock goes down.
Yeah, I also got to think that they had counsel in the room during these committee meetings that would be able to advise them not only of the plan and fiduciary issues, but they'd also kind of vet things through their general counsel. I would think as well to make sure that they're not skirting the securities law. And obviously, some new ground there. I'm reminded, Kevin, not that this is anywhere close, but you remember the WorldCom, the Enrons, those conversations about stock diversification. Well, maybe this predates and you're a lot younger than I am, but predates your time. But in the early 2000s, 2000, 2001.
In the early 2000s, we had a whole bunch of stock drop cases.
Yeah.
Yes.
And
I mean,
go
it's
ahead.
a balancing act because we want to encourage companies to offer plans. Employees like having ownership of the company that they work for because it provides them with some upside for growth, and it really aligns interests. On the other hand, we need to be careful that we don't promote it too far and put participants in a place where they've invested all of their savings into their employer, and they're left vulnerable.
Yeah,
It's a real balancing act.
Oh yeah, definitely. And I do remember back to those days when I was a record keeper, and I remember there were issues about in those particular instances about stock diversification where executives could move money out of the plan given they knew the financial condition, but the general public, because the stock diversification rules in the plan weren't allowed to, and it was more about that per se. And I would imagine that none of I don't think either of us we don't work on the plan, but I would imagine that IBM dealt with that aspect of the stock back then, because I think my recollection is a lot of plan sponsors said, okay, we're going to limit the amount of stock, or we're going to do X, Y, and Z to kind of prevent this from becoming an issue. So, I think it's interesting that we're coming nearly 20 years later, we're coming full circle again and talking about this issue.
Yeah, I think it's an issue that's not going to go away because when stocks go up, participants are happy, but when stocks go down, it's retirement savings that's lost.
Yeah, a lot of education I think needed there on the parts of obviously the participant needing to understand what that is. And again, we don't work on the plan, so we don't know what the summary plan description says. We don't know what's communicated, the record keeper, all those kind of things. The phone service at the call center. So we don't know what is said there. So really interesting case, Kevin. I mean, it's very rare, like you have said in the past, that the court takes ERISA cases, and it'll be interesting to see how this plays out because this has impacts to a lot of big organizations, a lot of organizations that offer stock.
It does, and we'll have to keep watching it, Jeff.
Yeah, absolutely. Well, Kevin, thanks so much for joining us, and really appreciate your time. Have a wonderful weekend, and we'll talk to you soon.
Thanks for having me on. Have a great weekend, everybody. Bye.
Well, that wraps up this episode of BRN Sunday. Hope you found it helpful and enjoyable and also educational. Don't forget, we are back at BRN AM tomorrow. That's Monday. And you can listen to us all week as we tackle all the news in retirement, personal finance, and more. So until next Sunday, I'm Jeff Snyder. Thanks for listening. Have a great rest of your weekend.